Hi, I'm Chance Finucane, Chief Investment Officer of Oxbow Advisors. Over the last 10 years, the U.S. stock market has delivered a total return of almost 250%. That's nearly 13% a year. Now we want to see what return should we expect going into the 2020s. In fact, it's actually been 3 of the last 4 decades that have delivered exceptional returns, which tells us that if we're being realistic, we shouldn't expect a result like that going into the next 10 years. There are numerous firms that develop forecasting models to try to create a projection of what the annual return would be in the stock market over the next 5 to 10 years. This is one that we like. The blue line represents this firm's expectation of what the next 10 years annual return will be. And the red line shows what the actual stock market result was. Right now it's sitting at about a 4% annual return. Another firm that has a model we like, KKR, which is one of the largest private equity firms in the world, projects a 5% annual return over the next 5 years. We think that 4 to 5% range is about right. Another way we can look at this is to try and take a bottoms-up perspective and look at the valuation multiples and the fundamentals. So first on valuation, over the last 25 years, the average price-to-earnings ratio of the S&P 500 is about 16 times. But right now it's sitting at 17 times. So we can't expect that valuation multiples are going to expand even further and help us get a greater return. We can also look at corporate profit growth. So there are different components we can look at, almost like looking at a company's income statement. First, revenue growth, which tends to track in line with nominal GDP growth. Nominal GDP is basically the growth in the economy plus inflation. And since 2010, it's tracked right around 4% a year. So we think that 4% is a decent assumption for what we think revenue will grow by over the next decade. After the revenue growth, we next want to take a look at profit margins, which are near record highs, mainly at the expense of employee wages. This is a consequence of the globalization and increase in automation that we've seen in the last 20 years. But if you've been reading the news, you can tell based off all the talk about wealth gaps and income inequality that we don't think companies are going to benefit from this trend that much longer. Companies are also paying the least amount of interest expense that we've seen in a long time, mainly due to the low interest rates in the marketplace. We think interest rates will stay low, but we just wanted to recognize that this is at an extreme relative to history. Finally, with the tax reforms that were implemented 2 years ago, corporations are paying the lowest tax rate that we've ever seen in the history of this country, something that we don't think can last forever. So to recap, if we want to look at this for a best case scenario of what annual return we would expect for the next 10 years, first, valuation multiples would have to stay at their above average levels. Revenue growth would have to stay at 4% a year. Profit margins have to stay near record highs. And then you need interest rates and tax rates to stay at all-time lows. Then if you add in a 2% dividend yield and a 3% annual share buyback, the best we can anticipate is 9% a year, which is already significantly below the 13% a year we just experienced. But being realistic, we probably expect a few of those factors to regress back towards their historical levels. The two we're paying the most attention to are profit margins and tax rates. And that's where we come back to that mid-single digit, say 4 to 6% return per year that we would anticipate for the 2020s. If you have any questions about that, please contact us.